fundamental to my whole theory of investment is diversification. And so I diversify the buildings, I diversify the locations, and I even diversify my investments. We operate some non-real estate investment portfolios. But I also like to diversify in currencies. Expect the unexpected. I think that's really the way you have to operate. You have to have staying power. You have to be able to stay in the game. One of the techniques that we use is we often partner with local people, local developers, local real estate investors, and they help us learn the market. We often have multiple deals with the same partner, or we buy a lot directly once we've learned the market. In Holland, I think we own 50 or 60 buildings that we bought in the last 10 or 15 years, the first few with partners. Now we have our own asset management office there, and we're fully functional on our own. We still partner with partners occasionally, but we have many that we own on our own, so we learn.
Francis Greenburger, thank you so much for coming on the show.
My pleasure. My pleasure.
So when I was doing some research, what to discuss today, you've done many different things with your life. You've had a very interesting career. I suppose we'll start where it all began for you. So you grew up in Forest Hills in Queens?
I was born actually in Manhattan, but when I was 3 or so, we moved from Manhattan to Forest Hills, Queens. Yep.
Okay. And both your parents were immigrants?
Actually, my father was born here, but his parents were Hungarian. He was born in upstate New York in Glens Falls. But interestingly, his parents and he went on a visit to Hungary, where they were from, in 1911, and they got caught there in World War I.
Oh, wow.
So they couldn't come back because boats were being blown out of the water. So he ended up going to high school in Budapest, and then came back after the war and went here to Columbia. But in that time, he learned to speak Hungarian.
Okay, wow.
And then my mother was German. She was born in Berlin. She left in the 30s because she didn't like the Nazis, and she ended up in south of France during World War II. Came to New York afterwards.
Wow, sounds like quite a mixture there. So, and your father was in the literary business?
My father was a literary agent, yes.
Okay, and you're still involved in that business today?
I still own the business, and I oversee it on a day-to-day basis. It's run by somebody who I hired 60 years ago.
Oh, wow.
And we met in Knight High School, and now she is one of the top agents in New York, and she represents a number of major clients, including Dan Brown, who is currently #1 in about 25 countries in the world simultaneously.
Wow. What's the genre of the book?
Dan Brown, well, he wrote the Da Vinci Code.
Do you know that one? Yeah.
The new one is called Secret of Secrets. Got published about 10 days ago. And it's #1 in 25 countries, including the U.S.
Wow. So I can imagine you're an avid reader.
I do read a lot.
Yeah, this is one of your first. So you wrote 2 books. You got a third one coming out. This is one of the books. Great read. I have to confess, I read it a few years ago now. But
Thank you.
When I was skimming it again before today's podcast, one of the things you talk about was learning to manage debt from your father.
This is true. My father was a wonderful man, but he wasn't a great businessman. And I became his bookkeeper when I was 12. Because nobody else was doing it. He was a 1.5 man business, or my mother was his half-time person.
Okay.
Anyway, he had a lot of debts, so I had to learn how to manage them when I was 12 years old.
That's a great skill to learn at a young age.
It is and I had no idea where it would lead me, but of course, in the real estate business, you're managing debt all the time.
Yeah.
And so I got some early training.
Okay, great. So we'll come on to discuss how you manage some capital stacks and some of your projects. But so you started Time Equities in 1966.
Correct.
Wow. Okay. And you became. Give us some early insights into your business.
Truth is, I started at probably 65, but I think 66 is one of the official dates.
If you've been wondering what types of deals we've been working on,
we made it easy for you. Just click on the link, show notes below.
We're talking real deals and real opportunities.
Whether you're an investor or owner or just curious to know what's going on behind the scenes.
Just click the link below and it'll bring you right to all of our available inventory.
Okay. And what was it like at that time? What sort of early things were the business investing in? What were the opportunities at that time?
Well, I was 16 years old, and I had started a small book business separate from my father's book distribution business, and I needed an office because I had one employee. And I went looking for a one-room office, and I bumped into some guy, but he had 2 offices for rent. And he said, look, I'm going to rent these. I don't want to rent them separately. Take the 2 rooms. I said, but I can only afford one. He said, I'm going to give you a real cheap rate. You'll rent it to somebody else and make a profit. And I said, okay. And the next day, I was paying $150 for the 2 rooms. The next day, I rented the smaller of the 2 for $150. So suddenly I had no rent because he was paying the rent for both rooms.
Sounds like a light bulb moment.
It was a light bulb moment, and I thought maybe it's easier to make money in a real estate business than it is selling books. And that's when I started taking the real estate business more seriously, and ended up expanding that same idea to 2 or 3 other properties, renting a larger space, breaking it up. You know, today, or at least for a while, we called it WeWork, but I was doing it 50 years ago.
So back in the 70s, you became as the co-op king of New York. I think you converted over 10,000 apartments.
Some people refer to me that way, yes. Well, the newspapers did.
And why did you feel there was opportunity in that sector at that time? What did you see that others didn't?
You know, first of all, there was a big gap, a giant gap between the investment value of apartments and the market value of those apartments retail if sold to somebody who was going to live in them.
Okay.
So, and that multiple was probably 5 or 10 times. So because of rent laws suppressing income and expenses being what they were, having investment apartments in New York was not very profitable, and the value of buildings had crashed. So here's a bigger example. I mean, a bigger project of mine. I bought a project in Brooklyn called Clinton Hill Apartments. It was 1,200 apartments, 13 buildings. I paid $5,000 an apartment. I sold.
Was it fully occupied at that time?
Fully occupied.
Okay.
I sold the apartments to people who lived in it for $15,000, and the market value, if vacant, was $30,000. So I was getting 3 times what I paid for each apartment, and the person who bought it could sell it the next day for twice what they paid.
Okay.
So it was a great deal for everybody. Plus, long, complicated story, but I was able to get beneficial financing so people could buy it with 5% down and get low-interest mortgages from the government. So you could buy your apartment with $750. And the next day, it would be worth $15,000 more than you paid.
It sounds like almost too good to be true, the arbitrage in value there, because like,
Well,
would you find an opportunity like that today in New York City?
In New York today, we're in a declining value cycle, as perhaps you know, because once again, the rent laws are such that they don't cover cost increases in expenses. So owners of buildings see their income going down every year. We've had the bankruptcy not only of lots of owners, but even a major bank, Signature Bank, closed because they made loans on these buildings, believing in the government of New York, and the government screwed them. And those buildings have declining income, so people couldn't pay their mortgages anymore. So we are in a cycle where values are contracting. However, the government then went ahead and, although for many years it encouraged home ownership, now takes the opposite point of view, and they made the conversion laws so strict that you can't convert buildings. Yeah. So it's a lose-lose. So it's really hard to own rental housing in New York. Now, sometimes there are ways to navigate under very particular regulations with buildings in very particular situations that can make them exceptions to the rule. But it's really difficult, and lots of people are suffering.
Interesting. So to put things into perspective, I think I've heard you say that back in the S&L crisis in the early 90s, late 80s, there were 2,000 banks that went into default.
That is correct. From 1987 until 1991, 2,000 banks in the United States closed. The government had planes just for bank regulators. They would fly into some small town. 20 of them would go to the bank. They'd walk in. They'd tell all the employees to go home, and they'd put up a sign and say "Bank closed." 2,000 banks in 4 years.
Wow. So if history repeats itself, not that we want to take that bad, obviously, but values could fall further in this.
Well, if we're talking New York City, there's a squeeze going on now, and what happens is every year, in primarily rent stabilized buildings, increases don't keep tabs with increase in costs, including the city taxes. Taxes go up 5 or 10% a year, but the city passes regulations or state that says you can only raise rents 1 or 2% a year. So how does that work?
Yeah.
I'm going to send more 5% increases to the government, but I'm only going to get 1% increases from my tenants. There's a mismatch there.
Particularly now, we might have a new mayor, and
he doesn't want us to have the 1 or 2%.
Yeah, the rent freezes. Yeah.
So it's just nuts.
With this said, I think you bought your first building since 2014.
So I bought. That's correct.
In Brooklyn.
Yeah. So basically, that was one of these buildings that falls in the cracks. So what it is that was a building that was built about, less than 10 years ago. The poor developer who built it, frankly, got wiped out because
their equity got wiped.
He got wiped out. So we bought it for the bank debt. So his equity was gone, and he knew it, but he wanted to have a clean record with the bank, so he just was happy to get out. And we paid the bank. So because really what the mortgage at that point, I think mortgage was $12 million or something, which is what we paid for the building. And the bank wanted him to pay the mortgage down to 8 or 9, but he didn't have 3 or 4 million. So he just wrote off, I don't know how much equity he had in the building, probably another 6 million. He lost all that. We wrote a check, we paid down the bank, put a smaller mortgage on because that's all the cash flow would support. Now, we bought it because under the tax abatement laws, now, as I say, the building was built 8 or 10 years ago. Tax abatement there, I forget exactly how long it is. Maybe it's 15 years. So there's 6 or 7 years left of tax abatement. Well, that's the good news and the bad news, because at the end of that period of time, the taxes will go up. However, at that time, under existing law, unless new mayors change it, the rents become decontrolled. So right now, the rents are below market because of the low stabilization increases. So it's a very particular case that would not apply generally.
Sounds like there might be a similar arbitrage in value to like the co-op example.
Exactly. So when the law changes and you're allowed to then charge market rents, suddenly there'll be a big increase in rents because they've been artificially suppressed, and then it'll have decent economics.
So you have a reputation throughout your career of buying assets below market value. How do you have the foresight, and what do you look for when analyzing an investment opportunity?
Well, those are two separate questions in a way. Yes, we do try to buy things where we get a good price. And we define good price in 2 ways. Either we buy very troubled buildings with a view that we can improve conditions, or we buy them for better than what we think the market pricing would be, typically at what we call positive leverage returns. I'll explain both in a minute. When buildings crash and burn, when their values get destroyed, it's often hard to determine what things are really worth. So when things are good, you're in the real estate investment business, you apply cap rates, and it's pretty clear. The income is such and such. It's a cap rate of 7%, 6%, 8%, whatever it is, and it's a formula, as you know. But when things get bad, then it's harder to determine value because, when something is empty or not profitable, it's much harder for the market to determine fair values. And sometimes you can find great buys.
Thanks for listening to the Broker Brunch. We've now brought you a ton of episodes and we hope we're providing a lot of value. If you have any ideas of people you'd like to see on future episodes, please drop it in the comments so we can make it happen.
What we've found is that the buying pool becomes smaller.
And the buying pool, because it takes a special point of view to be able to do it. To give you an example, we just bought a building in Boston. It's on a prime retail street, Washington Avenue. And the building last traded, I think, for $65 million. It's about a 60,000-foot building in a very prime retail location. It had been a Barnes & Noble for 30 years when these people paid $65 million for it. Well, Barnes & Noble moved out pre-COVID. Rents, of course, as a lot of places during COVID for retail, they collapsed, and there were no tenants. So the owners no longer could carry the building because they didn't have the income from Barnes & Noble. They couldn't rent it to anybody else. Building went into foreclosure. We ended up buying it from the bank, who had now sat on it for 4 years or 3 years, for $13 million. We were just the last person standing, down from $65 million. That's a pretty big decline. Now, we happened to know of a tenant that we thought would occupy 2 or 3, take over the retail. Typically, they're a 2 or 3 floor retailer who we were simultaneously negotiating with. So we had a vision for the building. And in fact, we ended up buying it, and we did sign up the retailer as a major name. And so the building value now is much higher. But, for a long time, people just looked at this building as a disaster. The bank looked at it as a disaster. They didn't want to put any money into it, fix it up. They didn't have the skills to rent it. When banks have buildings, they don't want to put any money into it.
And they don't want to own it, and they don't want to manage it either.
Yeah, so you can't really attract new tenants. I mean, the real estate business. When you put a new tenant in, you got to pay the broker commission, often a substantial amount of money. Often there's work that you have to do for the tenant. Often there's a free rent period. You have to carry it for a period of time. So you got to have money to invest in the building. Well, banks don't like to do that, typically. Once in a while, they might make an exception. So, these are orphans. And if you're in the right place at the right time, you can, with the right vision, you can make some great buys.
So in that instance, you had the inside information to have the right tenant to go in the right building at the right time.
And well, you have at least you have a vision for it. Or sometimes we just bought a building outside of Philadelphia in King of Prussia, an office building. Now, we all know how difficult the office market is today. But the truth is it's a weird market. There are winners and losers. Vacant office buildings are losers. But there's still some office buildings that are making money. Some are even full. And it's very, very building specific as to what's going on. This building is next to King of Prussia, which is a very strong market. It's the A-plus market outside of Philadelphia. And typically buildings in King of Prussia have traded historically for $200 or $300 a foot, higher than we would normally pay. This building traded, I think, the last time for $180. It was part of a big portfolio of office buildings that the bank ended up foreclosing because some were okay, some weren't. This building was 70% leased and was making a significant amount of money. I think $4 million a year, something like that, on the 70% occupancy.
Okay.
We ended up buying it for, my memory serves me, $23 million. And the leases were with excellent tenants, and they were long-term. So for the next I think it has 7 years of average lease term, this building's going to make 15 to 20%.
Sounds like in that instance, your downside risk is protected with only upside.
Exactly. And the market has activity in it, and we're actually negotiating for the remaining occupancy. The building will be a home run. We had to be in the right place at the right time with the guts to sign up while everybody says office is over, it's dead.
Yeah.
You can tear every office building in the country down.
Yeah.
So that's what buying below market or opportunistically means.
These bank buying opportunities, are they banks relationships you have directly with the bank, or are they coming through a broker? Or
There's usually brokers in the chain, but they're bankers designate their brokers, and it's competitively offered. Banks don't just do one-off deals to people because they have boards to be responsible to. It's a whole process, but the banks in the end want a reliable buyer with a demonstrated. I mean, you have to have the wherewithal. As you know, I mean, I don't know in your brokerage business, but these days often offering of properties are beauty contests. Not only do you have to offer the best price, but you have to really be a buyer that's highly, highly credible, because otherwise they don't want to deal with you, because a lot of people sign up contracts to buy buildings and don't close.
Yeah.
I mean, the failure rate is extraordinary. Well over 50%.
That's why we always insist on at least a 10% deposit. And as you said, not everyone performs. So I think the banks, for sure, and any seller wants certainty of execution.
Yeah, and if you're an institution, you don't want to go through the process of vetting offers and all this stuff.
Yeah.
And then, you get your board to vote and 92 people sign and salute, and then the deal falls apart. It makes you look foolish. And bankers don't like to look foolish.
So you have the unique perspective of owning properties, I think, in 36 states and 5 countries, including Europe.
Yes.
How has that perspective helped you in your real estate career, let's say?
Well, I think that, very early on, when I only owned buildings in New York City in the early 80s, and I was buying a shopping center in Connecticut, friends here in the business would say to me, well, what do you know about shopping centers in Connecticut? You're going to make a mistake. I said, I know I'll make a mistake, but I also know it's a mistake to be overly concentrated on only own things there. So slowly I learned how to own shopping centers in other states, further and further away, all different property types, et cetera. And once I learned that you could cross state borders, the next border I crossed was into Canada. Now, some Americans think that Canada is part of the U.S. That's not the case.
They might be offended by that.
And in fact, in Quebec, all contracts are in French,
Okay.
let alone being part of the U.S. So, and we were very active in Canada for a number of years. That was our first international diversification. We entered the market at a particularly weak point in Canada, and we bought 20, 30 buildings.
Was there any point when you were taking them leaps of faith to Canada and other countries that you felt like a bit like a fish out of water, that you felt uncomfortable, that you didn't know the environment?
Of course, but one of the techniques that we use is we often partner with local people,
That's smart.
Local developers, local real estate investors, and they help us learn the market. And then once we've learned it, then sometimes we often have multiple deals with the same partner, or we buy a lot directly once we've learned the market. For instance, in Holland, I think we own 50 or 60 buildings that we bought in the last 10 or 15 years, the first few with partners. Now we have our own asset management office there, and we're fully functional on our own. We still partner with partners occasionally, but we have many that we own on our own. So we learn. And that's sort of our general approach to markets that we don't know.
How did the opportunity in Holland come about? New regulation, different continents?
Well, Holland was in the Dutch economy went through a free fall for whatever reason, normal sort of economic cycle. A lot of the local real estate players were hurt, which often happens because it was their market, and they were concentrated in Holland. They didn't own things in Germany or other places that were doing better. And I was actually in Spain looking around thinking, because the Spanish economy had gone through a very long, difficult period, at some opportunities there, but I found the Spanish market not transparent and it didn't transact the way things do in the U.S. in many countries. It was, simplest information. Who are the tenants or who are the rents? So, well, you have to figure that out yourself. What are you kidding? So, while I was trying to deal with some nice Spanish people, but one of the people from my office was traveling. He says, I just got this portfolio of single-tenant buildings, 70% are full, 30% are empty, and it's trading for an 11 cap on the income from the 70% that are occupied, and the rest are for free. I said, well, that sounds interesting. I said, it can't be. It's not possible, because Europe trades at lower cap rates typically than the U.S. I would have expected
because the borrowing, the debt is lower. It's cheaper to borrow.
Yes, among other reasons. Yes, I would have expected this to trade at 5.5%, not 11. So I said, well, why don't you check it out and see whether it's real or not? Well, it turned out to be real. And that's when we became aware of the fact that Holland was in this deep contraction. No Dutch banks were lending money on any Dutch properties. Maybe if you were in Amsterdam and had a 10-year lease with a AAA credit, maybe you could get a mortgage. But if you were anywhere else in Holland, which is a country that has a lot of communities outside of Amsterdam, you couldn't get a mortgage on anything. And this was a portfolio of properties. So I said, okay, we'll pay cash. And we did. And that was the first thing we did. And then we understood what was going on in the market. And there weren't that many buyers around. And we started scooping up things that
Interesting.
were very attractive. Now Holland is trading at, has recovered fully and is a very strong market. And we can't buy anything. It's hard to buy anything. But what we bought years ago has performed brilliantly. And
wow. I don't know if you not thought about it this time, but also you'd have a competitive advantage against the local buyers if the dollar was strong. The current currency.
The currency is always complicated in the sense that it's like interest rates. You don't know where they're going to be tomorrow.
Yeah.
Of course, Holland trades in euros, and I've watched the euro go from, God knows, 85 cents to $1.20 or $1.25, back to $1.06. Now it's $1.18. And I couldn't tell you exactly why. Because most of my assets are in dollars. When I buy in a foreign country, I buy in I buy in euros or Canadian currency. And in fact, we often don't even repatriate our profits because we like to have money in. Fundamental to my whole theory of investing is diversification. And so I diversify the buildings, I diversify the locations, and I even diversify my investments. We operate some non-real estate investment portfolios and private equity and hedge funds and things like that. But I also like to diversify in currencies. So we have significant euro holdings, Canadian currency holdings, British pound holdings. Saying, the British pound. One day it's $1.80, the next day it's $1.15, and the next day it's $1.40.
This reminds me of 2009. I know that a lot of groups have London bought in New York just because the pound was so weak. Sorry, the dollar was so weak relative to the pound.
The dollar a pound balance. I mean, it can be accretive in and of itself. But I'm more interested in the fundamentals of what I'm buying.
Yeah.
As opposed,
you're buying the real estate, not
I'm buying the real estate, not the currency. Sometimes I get great deals, and the currency's high.
Yeah.
And the currency could go down 10%. I bought buildings when the euro was $1.21, and woke up the next day and the euro was $1.06. So it was the opposite. But I made great buys at $1.20, so even if I discounted the currency 10%, it didn't matter.
I see.
And sometimes it goes the other way.
What are you up to in the UK?
In the UK, we don't have anything in Great Britain now. We had a couple of assets that we bought during COVID and then ended up selling very accretively near Manchester and a couple of places like that. We recently also bought, this was like within 12 months after, the British real estate funds had a lot of redemptions during COVID, and they're required to sell assets to meet redemptions. So there were fire sales, and there weren't a lot of buyers around. We bought a a shopping center up in northern Scotland in Inverness, and I think we bought it at a double-digit cap rate, 12, 13%, which we felt was a great price. Significantly marked down from where it had last traded, where the fund had bought it, but they needed the money. So we bought it, and then about a year ago, suddenly the whole market had righted itself. Not a single tenant changed. Nobody's rent went up, nobody's rent went down. It was the same shopping center, and we sold it. We bought it for £18 million. We sold it for £36 million.
Wow.
Just
It's a nice
because
IRR return.
cap rate changed. Cap rate, we bought it at 12 or 13. Cap rate went down to 6.5. Market conditions changed. The economy.
To my knowledge, a lot of American companies have bought in the UK over the past 5 years or so. I think there's just more money in America. Then there's more liquidity, I would say, to my knowledge anyway.
It's true. I mean, Britain does not have as robust mortgage financing as available here.
Yeah.
Typically, you don't get more than 50% leverage, and rates are high. They're higher in Great Britain than they are in Europe, for instance. We just bought an office building in Glasgow
Okay.
in August, which we think we got a good deal at. Of course, otherwise we wouldn't have bought it. That we had a particular point of view. A lot of buildings, office buildings in Glasgow, which is a heavily occupied market, not like some American office markets that are. But most people buy buildings and then they upgrade them, and the market for upgraded office is in the high 30s pounds per square foot. This building was rented at about $20 square foot, 20 pounds per square foot. But it wasn't new, but it was maybe had been renovated 20 years ago.
Okay.
So it was a little bit tired, and we just decided the price was too high to add the cost of refurbishment and make it very accretive. Plus, you'd be then competing with all the other buildings that had upgraded. So we decided that we like the idea that there's a market for good B quality, and this building was in a very good location. But where we did nothing and rented at 18 or 20 pounds, that would be attractive to some owners. And so we have Scottish Rail in the building, and it's 2 blocks from the rail station, so they like it. And they're paying 20 pounds instead of 35 or 40 that they would pay in a new building. So it's just we have a particular point of view about the market.
How else would you say that the European market differs to the US? Anything else come to mind?
There are differences. For instance, their green standards are much higher than ours.
Okay.
And their phase-in dates are more aggressive. So you have to be very careful that you understand what the upgrades are needed to meet not only today's code but future code. So that's one difference. The office buildings, for instance, in Europe, all have to have you're not allowed to have offices that have no windows. It's like bedrooms in the U.S. You can't have bedrooms. Well, you can have alcoves, but you have to have window line in all offices. You can't have 100-foot depth buildings and dark workspaces in between with no windows. So it means buildings are narrower, which it turns out, as there's a lot of talk about converting office buildings to residential.
Yep, that's the next topic.
As you get into that, you realize that office buildings that are very deep are not suitable for conversion. So if you have a 100-foot deep building, that does, residential buildings, apartments can be 30 feet deep, maximum. If you think about how big is a living room, 18-foot living room is pretty big. And you can stick a windowless bathroom behind it, but then all you have is darkness. So really, on a practical level, you can use 30 double-loaded corridor, 30 and 30. You can use 60 foot of depth, and then about 10 foot for the hallway. So 70 foot. If you have a 100-foot building, you really have 30 feet that's wasted, and they're not. So it's not efficient to convert it. but because European have these window lines, it turns out that almost all office buildings in Europe can be easily converted to residential. And that's a trend in Holland these days. So anytime we have a building that's underperforming or loses a big office tenant, we can sell it to a residential converter for a very good price overnight.
Thank you for listening to The Broker Brunch. If you enjoy the show, please hit subscribe so we can reach more people.
You're reminding me of when I was a young broker in London before I moved to the US, and the government, we did a lot of them. I was working in an office team that sold suburban offices. They do like BC offices to convert to residential. The government introduces something called permitted development, whereby you can convert an office building to residential without any planning or your zoning change. So there's a lot of that happening at that time. And so are you looking at them opportunities in New York? There's a lot of vacant office buildings here.
We've looked at, we're doing a number of office conversions outside of New York.
Okay.
To be honest, until I see a more positive attitude from government towards owners, and I'm discouraged about taking on new projects in New York right now. I mean, just got to be honest about it. I love New York. It's where I live. I've grown up here. But our politics are so anti-ownership and so illogical and so uneconomic that, I'm afraid to. And, even if the numbers add up on Tuesday, they've changed the law on Wednesday, and you're out of luck. So as much as I hate to say it, it's hard for me to convince myself that. So, we just built a huge building in Chicago.
That's my next topic, 1000M.
1000M.
So tell us about that. How did that opportunity come about? It's one of the premier buildings in Chicago, if not the premier building. It's over 700 units of residential rentals, I believe.
Correct.
So yeah, please share the story, how that came about.
So I had done, we've owned property in and around Chicago for many, many years. But about, I forget, 10 years ago, whenever it was, 15 years ago, we did a loft conversion there together with a partner, Jerry and Jordan Carlick. And it was very successful. We bought some loft building that had been a failed development by somebody else from a bank. It was REO, bought it well. And I forget, it was 2009, so it was post-world financial collapse. There wasn't a lot of money around, got a very good price. And we managed to put bought it for cash, ultimately got a bank loan, converted it to residential. It was a very successful project because nobody could get money then, and there was not a lot of conversion product coming into the market, so we rented up instantly. So it was very successful. And then one day Jerry came to me, my partner, and said, oh, well, there's this wonderful building on Michigan Avenue, which is the Fifth Avenue of Chicago. And we should buy it, and it comes with some air rights, which one day will be valuable because there's a site next to it, and eventually that developer will have to buy it from us. I looked at the pricing and I said, Jerry, this building really isn't worth the price that we're paying. I said, maybe if we sell the air rights, and then it might be okay. But I said, to sit around and wait for somebody to buy the building site next door and need our air rights, it's not my kind of thing.
Out of your control, right?
Out of my control. I said, why don't you go find out who owns the site next door, and maybe we'll buy it, and then we can use our air rights ourselves, and we'll control what's going on, and we'll have a clear plan. So he checks, and the site next door had been a failed development site by another developer, and that developer had lost it to the bank, so it was REO with the bank. And the bank had held it for a number of years. They were anxious to find a buyer. So we were able to enter into a very fair deal with them. And we then went through, in fact, they let us go through entitlement while we only had a contract. We hadn't closed on it yet. And entitlement was tricky because it was in a historic district. In New York, if you went to the historic district, regardless of what the buildings looked like, and said, well, I want to build a new building here, they'd shoot you. You know, they would throw you out the door.
Yeah.
So we went to the local officials, and we said, look, you know, yeah, this is the last block of a historic district, but frankly, other than our neighbor to the north, to the south, there's this empty site and a couple of crappy buildings from the 40s that are not historic in any way. And they said, well, you know, you're right. We'd like some development there, and if you bring us the right vision, we'll consider moving the border of the historic district just north of your property, because you're right, those buildings aren't historic. That would never happen in New York in 1,000 years. And so, of course, I was surprised, and okay. And we came up with a plan that we thought they'd like, and we employed an architect I had worked in New York. He's a star architect, you know, one of probably 10 star architects in the world. Unfortunately, he died a couple of years ago. Helmut Jahn. But he had, even though he was born in Germany, he had lived in Chicago most of his life. He was a favorite son. He was considered an icon in Chicago. So when he came in, first of all, the city planners and everybody respected him a great deal. So it carried a lot of weight. And so the city said, yes, and thank you.
So you started construction just in COVID? Or just before COVID,
we started the foundation just as COVID was breaking.
Okay. And so what was that like during that time, managing the capital stack? I can imagine you had some interesting conversations with your lenders.
Yeah, so, you know, it became problematic for two reasons. We had gotten we had closed financing to build up through the foundation with a promise from our lender that they would then provide a full construction loan. But they wanted us to start on the foundation, and then they would finish the rest of it. Well, as soon as COVID came around, they were getting nervous. Also, we had been pre-selling apartments, and although sales had been going pretty well, we sold 100 pre-construction out of 400, we were only selling the cheap apartments.
Okay.
And we weren't making any money on the cheap apartments. We were just breaking even. The profit was all in the upstairs apartments, and nobody was buying those. So that was a pattern that was bothering me.
The market was saying something to you, and you pivoted.
The market was saying something to me. The lender was saying, you know, well, for instance, we're a little nervous now. It's COVID. We're not saying no, but we're not. Meanwhile, so I decided I was going to stop. Even though we had just finished the foundation, we were about to bring the cranes in and go vertical. This was in April of 2020.
Okay, wow.
And you remember, you know, I and a lot of people were operating from our apartments on our cell phones because the offices were closed. I said, no, you know what? Even though construction, theoretically, you could continue because it was seen as an essential service or whatever they called it, but like we would have had to pour the mat slab, what's called a mat slab, which takes 200, 300 people on site. You know, they're standing next to each other, and you can't pour a mat slab. But the regulation said they had to be 20 feet apart. How could you do that? I just said, you know what? Let's stop. And we did. Just stopped and said, we'll wait till things get better. And during that time, we started looking at the sales pattern and saying, well, maybe we should turn this into a rental instead of a condo. Maybe that's what the market really wants. So we listened.
I think I read somewhere that you ripped up $6 million worth of plans for condos.
Well, you know, that you would think we didn't, at that point, we didn't change the outside of the building. So you think, well, the architect can just take out the eraser, erase a few lines, put a few more in. Doesn't work like that, you know. All of the infrastructure, the plumbing, the stacks, yes, we ripped up $6 million of plans, and we drew $6 million of new ones.
Wow. And so you're writing another book on the Autobiography of a Skyscraper. What made you want to write a book? I've pre-ordered it. I think it comes out in November.
Well, thank you. You know, one of the things that I learned early in my development career, but it became particularly true when I built 50 West Street, there's so many development, people think of the developer, oh, it's this guy or that guy or that woman. It's not. It's a team. It's a very dedicated team. You've got design professionals, you've got city planners, you've got bankers, and you have construction trades who put their lives in these buildings. A big building, up to 1,000 people can work on it, certainly 500. You can have 300 people on the site in one day. So I thought it would be good to tell their story, because I don't know that people who are just interested as a pastime in development or even architects who designed the thing. I didn't think everybody really understood that it was a team sport. This wasn't one, it wasn't the quarterback or somebody who determines the game. It's the whole full team. And I wanted to pay homage to the team. So that's the book. And during the construction of 1000M, we interviewed everybody who worked on the project, from the laborers to the plumbers to the electricians to the city planners, the bankers. Everybody got to tell their story. And that's what the book does. And I think for people who are interested in what development is really all about, hopefully the book will be interested. And of course, it's documented with photographs of the whole process as we went through. So it's...
Wow, I look forward to reading it.
I hope you find it of interest.
I will do, I'm sure. So there's a lot of learning lessons from that project. Another project of yours in downtown Manhattan that I'm sure you've learned a lot of lessons from was 50 West Street. So you were about to build that project as a condo building. You're about to build before the GFC.
Yes, and ironically, sort of the same thing happened there that then happened years later with...
You've overcome some obstacles, it's fair to say.
So there again, we put the foundation in the ground. Suddenly, we had the world financial collapse. And we had we had a financing for the foundation with the full building financing promised but to follow. Meanwhile,
and you had the same architect as well, Helmut.
And I had Helmut working on it. Well, what happened was that originally we conceived of it as a hotel and condominium, condominiums and a hotel. And as we started looking for financing, people were saying to us, well, we like to finance hotels, but we don't like to finance condos. Or they'd say, we like to finance condos, but we don't like to finance hotels. Well, this was a hotel-condo combination. And it was really hard to find people who wanted to do both.
Okay.
Plus, in those days, even still true today, with rare exceptions, for condo projects, most banks don't want to take exposure of more than $75 or $100 million. For 50 West, our loan was, I can't remember, $300-400 million, something like that. I think the whole project was $550. So you have to put together a group of banks. So not only do you have to find one bank who will tolerate co-op condos, you got to find 4 or 5. That was hard. So eventually, and it was hard to find the right hotel operator. And we talked to many, Marriott, they got one down the block. Oh, this one, they have this. Or, well, they might be, but they have to, lots of interest, but nobody really ready to sign on the dotted line. So we just decided, and then we stopped at the world financial crisis. I said, we're going to wait. Foundation was done. Again, we didn't go vertical. And we sat on an empty site for years, ticking away at interest and taxes of $4 million a year. I'm writing checks till I'm blue in the face. And I put the head of my development department left, and I put his assistant, a guy who started as an intern, in charge. I said, well, you're going to babysit a hole in the ground. He said, well, what do I do? I said, well, just make sure. Don't fall in it.
That's called learning on the job.
Right. But he's a very, very capable, bright guy. He's now head of my development department. And he thought about it, and he said, well, maybe we should get rid of the hotel. Because that's the problem. We can't find people who want to do both. Let's just make it all condos. And he studied the condo market, and he saw when you really understood the curve, that there was, even though this was like 2010 or 2009, that there was a convergence where the supply was going down.
Okay.
And the demand, even at a modest level that it was after 2008, soon they were going to run out of apartments in 2012. So he argued that we should be in the ground whenever, I can't remember the exact dates, 2011, delivering in 2013, and we would hit that particular point where demand had outstripped supply and there would be a shortage in the market. Even though, obviously, in 2009 and 10, nobody was feeling rosy. And but he put together a convincing argument. We got rid of the hotel. Now it was easier to get financing, not easy. We had to assemble 5 banks, but we got them. And then we were off to the races. And when we started, we needed $1,600 a foot to have a profit. $1,300 was our break even. And in those days, Battery Park was trading for about $1,300. But one of the things that's misunderstood about Battery Park is they call them condominiums, but that's a state invention. The state owns the land, and their pilot payments, rent payments that get paid to the state. So it's like a building on really a land lease.
Like a long-term ground lease. Something.
Like a long-term ground lease. There's a law in the state of New York that if you have a condo or apartment ownership on a long-term lease, you must call it a co-op. You're not allowed to call it a condo. But because this was a state project, they changed the law for them, and everywhere in the city it's a co-op except in Battery Park.
Wow.
There it's allowed to be called a condo, even though it's really a land lease. So what that meant was that the $1,300 price was not a true price for a condo. It was it was like the equivalent of a co-op price because there was a land lease under it, or effectively a mortgage or liability. So the price was misunderstood, and when you really understood what it meant, it was the equivalent to $1,700. So we felt comfortable projecting $1,600. Well, as history would show, 2012 there was an inflection point in the market. Supply was short.
Condos at that time were taking off in terms of values.
And then suddenly prices were well over $2,000. And we ended up selling at like $2,300, which was Christmas.
Wow, so that's a great project. So you've navigated countless market cycles.
Countless.
What lessons have you learned? This is a big question. What lessons have you learned about being resilient in real estate? You've faced so many challenges. We've touched on a few of them there.
Well, first of all, I've adopted both for my business and my family the motto, expect the unexpected.
Okay.
Expect the unexpected.
I like that.
And I think that's really the way you have to operate. One of my long-term colleagues and partners calls it, you have to have staying power. You have to be able...
Stay in the game.
You have to be able to stay in the game, just like, most people or a lot of people, if they had a 50 West happen to them and they had to write checks of $4 million a year, they would have turned the property over, they would have walked away from it, and the banks would have moved in. But we had enough resources to carry it, and that's why we were able to. And the bank debt, I think, was, I can't remember at that point, maybe it was $30 million or something. When we started building the second time around, the bank appraisal was $130 million for the land. So if we had been weak-kneed and walked away from it, and the bank would have ended up with it,
Wow.
we would have walked away from a $100 million increment just in the land value, not to speak about the building.
So the moral story there is if you hold on to the asset long enough, the market will do the work for you.
Often.
It reminds me of something Warren Buffett says in terms of compounding. If you invest $25,000 or $5,000, however a small amount, in an investment account and let the stock market, the S&P 500, take it over enough time, it's going to compound, and it's about staying in the game.
Yep. So you got it, but one other expression I use is make hay while the sun shines, but carry a large umbrella. In real estate terms, umbrella means cash. So
Okay.
you can't run a real estate company and a development company without having substantial working capital, substantial reserves, because you're going to hit a problem. And if you can't pay for it, you're going to be out of luck. So you've got to have resources to meet these contingencies, which are predictable and inevitable.
We're back. Another season of the Broker Brunch podcast. Summertime in New York. We've got a lot of exciting conversations coming up. We hope you enjoy listening. Great words of wisdom there. So moving on to one of your upcoming projects in Boynton Beach in Palm Beach. So you're planning to build over 900 apartments. There's a whole town square redevelopment there.
Yes.
How's that project going? Is this your first investment in Florida?
No, we own a lot of property in Florida.
Okay.
And in fact, during COVID, we completed another development in West Palm, which was extremely successful because, again, our timing by accident more than planning.
A lot of New Yorkers fled to
Was,
COVID.
just as West Palm was exploding, our project was opening when there were no other projects opening. We literally started it a month before COVID, and there we continued construction, and we built it in the first 14 months of COVID on time and on budget, or actually below budget. And it was a very, very successful project, not only in timing, but in quality. It was a quality that West Palm hadn't seen before. As a result, our presence as a developer in Palm Beach County was well established. And this Boynton Beach situation, which is about 10 or 15 minutes south of West Palm, it's a small city or medium-sized city. And the town of Boynton Beach about 10 years before had decided to build a new town center. And I'm not sure how they did it, but they put together a site of 14 acres, which is an enormous site for Palm Beach County, probably one of the biggest sites in the county. And they took 4 acres in the center of it, and they built their new town hall. They built a town hall building. They built, a library. They built a children's park. They built an amphitheater, all the kinds of things you might have in a town center. And there were 2 4-acre bookends on each end and a 2-acre site in the back. They envisioned a hotel in the 2 acres in the back and residential on the 2 4-acre bookends. And they made a deal with a developer there, but frankly, the government at that time was not very smart, and they had very bad legal representation. They entered in a stupid deal with the developer, who then proceeded not to develop the site, but sit on it. Either he didn't have the wherewithal to build or whatever he did. And they ended up suing him. Oh. And eventually he realized that he's never going to build on it because the town hated him. The mayor that made the stupid deal with him and the city council was voted out of office because the town became aware of this screwed up thing. And they floated bonds for $100 million to pay for the new town center, which was, and the interest on that was supposed to be paid by the taxes from the residential bookends. But of course, the guy never built, so there were no taxes. Okay. So it was a big mess. And just about the time we finished Casamara, that's the project in West Palm, whatever, the developer decided to put the thing on the market. And everybody related, all the usual flavors down there bid, as did we. But the developer, bless his heart, bless his soul, was astute, and he realized that somehow he took confidence in us more than the other big developers, all the names that you know, and thought we could do a better job with it. And the town, the mayor, the new mayor, because it was a new government, I think the mayor had actually lived in our project for 6 months while something was going on at his house, and he loved it. So they welcomed us with welcome arms. In fact, our first meeting was to bring the mayor and the city council to our project in West Palm, and they liked what they saw, and they said, we want something like this there. So we got together with the town, we got together with the developer. We had to settle the lawsuit between the town and the developer, which was vicious. I mean, they hated each other.
Sounds complex.
It was complex, but we were the white knight. Everybody came out ahead, settled the suit. The developer got money. Town was happy. Town bought into our vision, and now we're off to the races. And we ended up, frankly, getting an advantageous deal in buying the land because it was such a mess that it really took some
When are you planning to break ground there?
We're planning to break down ground next May. It's a big project, very big. It's 900 units, 450 on one site, 450 on the other. We'll start with one phase, and then we'll do the second phase when we complete the first. Town was cooperative. Eventually, just last round, we told them we needed tax relief because of the difficult interest rate environment, which they gave us because we could demonstrate our economic need. So, and we think it's a really exceptional project. I mean, we do very high quality, very high design, and heavily amenitized. The building 1000M is a 1 million foot building. We have 80,000 square feet of amenities.
Wow. We
have indoor swimming pools, outdoor swimming pools. We have half court basketball. We have everything. We have meditational gardens. We have, you name it, we have it. So people not only live in the apartments, they live in the whole building. They live in the community that we create. So it's a different vision than the old, than we typically used to do.
Okay. Moving on from real estate to another one of your big passions in life is the arts. So what initially piqued your interest in the art world? How did you...
I think somehow I was born with a design gene or something. I love design, and I love it whether it's expressed in the visual arts or whether it's expressed in architecture. I think that's what makes me a decent developer. But it's the same instinct. I bought my first painting when I was 14 years old.
That's young to start collecting.
Yeah. I walked into some gallery. I was dating a little bit older girl who was working in this gallery. And I walk in, and the guy who owns the gallery sees me looking at some painting. He says, well, he said, you like that painting? I said, well, I don't have any money. I can't afford anything. He said, just make me an offer. We're closing up here. We're closing the business. So I said, well, I'll give you $20. And he said, okay.
Sounds like another under market value buy.
I still have that painting in my personal office. I look at it every day. It's been 60 years.
Wow.
It's a realist painting of an elevated subway, which I used to ride with my dad when we were kids, the IRT from Queens. Turned out I thought it was a New York subway. A curator that runs my collection many years later researched it, which I didn't ask her to do, and it turned out that it was Philadelphia, it wasn't New York. But I still see it relative to these memories of my dad. Anyway, I really like the painting. It's now 2,000 or 3,000 paintings later, and I discovered that I'm not the only person who likes art.
Like a lot of people in real estate like art.
Well, real estate, turns out a lot of people who reside in buildings like art.
Yeah.
So we fill up our buildings. 1000M has almost 200 artworks in it, lobbies, lounges, everywhere. And it gives a feeling to the building. I mean, some people don't like it. Not that they don't like it, but they're indifferent to it. Yeah. But a lot of people do, and they like the tone it sets. I was once I bought these buildings from the Lehman estate in Detroit, huge apartment, office complex, almost 1 million feet. I bought it for $25 a foot when Lehman went bust. And I was trying to spoof up the building, make it look nicer. So I, of course, put art in it because that's what I do. And one day I was talking to the broker there. We just signed 2 leases, one for 100,000 feet, one for 250. And I said, what do people think of the art? And he says, it's funny you should mention that, because I was talking to both of these big tenants, and they said, some of this art we like, some of it we don't. But what we like is it shows that the owner cares about the building. And that resonated with me, and so I keep that in mind, and I think it's true. So I've been able to integrate my personal interest in art with my work.
I feel like there's great correlation between real estate and the arts and writing. A lot of being a real estate developer, you need to be very creative. So I can imagine it gets the juices flowing.
I think it does, and I think good developers are very creative, and bad developers are not.
How has this creativity influenced your approach to business? I imagine when you're looking at a project with an architect, then from the design perspective, you just mentioned that.
Well, I often see art opportunities. Like I bought a building in Phoenix recently, or a couple of years ago. And I walked in and there was it's a big atrium building. And the atrium space was sort of empty and desolate. They'd fixed the building up nicely, but I don't know, the atrium space was horrible. And that was your arrival experience. Sort of looked like an untendered swimming pool or something. I don't know. And I thought, well, maybe if you put a big sculpture in the middle of that lobby, in that atrium, it would just spiff up the whole place and add a better sense to it. So I was looking around. So we bought the building. I'm looking around. What am I going to put in this atrium? And I was in Athens, and I walked into a museum, and I saw this giant sculpture that was 1.5 stories high. I said, "Oh, this is perfect because it's a 3-story atrium." I said, "This is perfect," and it was hard to describe, but it had a lot of hanging elements that were like fabrics or materials. Sort of had a little bit of a Native American feel to some of these materials that were part of the material that went into the sculpture. I thought, well, maybe this will work, and so I tracked down the artist. It was in a museum, but it said on loan from the artist. So I tracked him down and said, well, what are you going to do with it when it comes out of the museum? He said, well, it turned out the artist wasn't in Greece. He was in Belgium. I made a deal, bought it, and he brought it over and saw it himself in the atrium. Well, the unexpected happened. Several tenants, including a key leasing broker in that market, hated this sculpture, hated it, and said that if we didn't remove it, he would never rent new space in the building. But never.
That's a strong statement.
Yeah, I mean, I thought it was insane. I mean, you could not like it, but we know what's important to brokers: commissions. So you're not going to bring clients because you don't like the sculpture. Anyway, it became such a cause célèbre that I took it out a month ago. I took it out, and I found 2 or 3 possible replacements. One of them is sort of very simple white sculpture that, I mean, I couldn't imagine anybody objecting to it. In fact, you'd look at it and say, well, it doesn't really have much texture to it. And of course, the tenants loved it because we did a survey. I wasn't going to put it in without asking this time. And a Spanish sculptor, he just installed it about a week ago. Everybody's happy now. So art can be complicated.
Yeah, it can bring people together. So one of the non-profits you're involved in is OMI.
That's correct.
Up in upstate New York and Ghent. So it's an international arts and centre. You are having a new initiative there, a new project, the OMI Pavilions.
That's correct.
Can you share with us your vision for that project? You have some big names on board. My wife tells me, I was telling you before the show, my wife's a painter. I was showing her some of the research before this conversation. She said there were some big names like Alice Aycock and Susan and Michael Hart. So they're committed to the project.
So what this is, this is a typical fantasy dream that some crazy art-loving developer might have. So I decided to develop this. This is a sister project to Art OMI, but it's about 15 minutes away in its own campus. So it's a 200-acre campus, spectacular landscape, one of the most, I mean, Hudson Valley is famous for its views. This is one of the best. And it's a plateau way up high, and you see forever. So that's the site. And the idea is to get 18 collectors or artists who want to create a legacy pavilion, another word for building or small museum, around their collection or their artwork, depending whether they're artist or collector.
So collectors are buying these pavilions to store art?
Well, no. They're creating legacy exhibitions of their collection or, in the case of an artist, of the artist's work. So Alice Aycock is one of the top 2 or 3 women sculptors in America, celebrated endlessly for the last 50 years. And she wanted to create a place, because when work goes to a museum, 98% of the work goes into storage and is never seen. So some artists want to have a place where their work they can know that it's going to be seen, and they can create a legacy for themselves. And that was Alice's situation. Her work's in probably every museum in the United States, but it might be in storage, and she wanted to have a place where she could sort of make a legacy statement, and that's what she's doing. So she's one building. The Horts are one of the most prominent collectors of contemporary art in New York. They've been collecting for 40 years or more, and they have 6,000 works in their collection, probably as much art as most regional museums by themselves.
Wow.
And again, they had a tragedy in their family, both at an early age and later, more recently. First, their daughter died of a rare cancer, and later their son did. And the son was going to carry their legacy forward, but he died. And I knew Michael and Susan for some time, so I went to them. And at first, they weren't convinced about the location, even though their son had lived in that area. They were more New Jersey oriented. But they came around, and so we're building with them their legacy for their collection. And it's a legendary collection, and they have most of the big names of the last 40 years represented in it. So on this site, you're going to have a mixture of pavilions devoted to famous artists, where they'll make their legacy statements, or collectors who do the same. 18 of them, plus the visitor center. So it's a very big vision. Each collector or artist chooses their own architect. So each of the buildings will also be an architectural statement. Alice designed her own building, but she then ended up working, because at one point I had introduced her to Helmut Jahn. The Jahn studio helped her do the final drawings, but it's sort of her design because she's got an architectural background. The Horts were less concerned. I teamed them up with an architect I thought they could work well with, a firm called BKSK. But we have one building which is extraordinary architectural construction that's sort of hard to describe. It looks like an upside-down umbrella, or not an upside-down umbrella, a right-size umbrella. It has a big bonnet on top and then these smaller galleries underneath. And that's designed by a firm that's very known for its, it's called. They're top of their profession right now. They're doing the Williams Art Museum in Williamstown, Massachusetts.
I'm visualizing in my head something like the Storm King Art Center. I'm sure you've probably been there.
Storm King is more, their building is modest and they have more landscape. We have similar landscape, but we've got all these buildings. We have one of the first 3D printed buildings in the Northeast is going in there. So the architecture, the landscape's extraordinary, the architecture's extraordinary, and the art's extraordinary. So it's a big vision, but
I'm sure a big success like everything else in your life. When's
I'm
open
not
to the
sure
public?
about that, but we're going to do our best. Right now, we're hoping to open to the public fall of 26.
Okay.
And we're in construction as we speak.
I'll definitely have to take a visit. So another nonprofit involved with the Greenburger Center of Social and Criminal Justice. You have the Hope House scheduled to open in 26. Can you share with the audience?
That's an alternative to incarceration for people with serious mental illness. It's located in the Bronx. It's a very complicated subject, but, America closed all of its mental health hospitals in the 1950s. We had 550,000 beds for people with serious mental illness in the United States. We have 35,000 now. We closed 95% of the mental health beds in the U.S. What happened to all those people? Population doubled, so if we had 550 then, we need 1 million one. Well, we built 1 million jail cells. So we took them out of the hospitals and we put them in jail. And so you'll often read or hear that our jails are mostly mental health facilities.
Mm.
We think that a better solution should be found. And so we've created this alternative to incarceration facility where people will get treatment but still be in a secure facility because these are people who committed some sort of difficult behavior. These are felony level crimes. But who the judge and the attorney general and the defendant want to have a chance at rehabilitation. So they can go into this facility. It's locked. They can't just walk out. If they want to leave, they can go, but they can go to the judge and they'll put them back in jail. So it's a way to address mental health in a more positive way than prisons. And it turns out that prisons for mental health people are very expensive. Mm-hmm. So our solution will not only give a better outcome, because 98% of people get released from prison. So it's not like these serious mental ill people are going away. And prison makes them worse. So we're really taking people with problems and making them worse and then releasing them into society. We hope to make them better.
That sounds like very meaningful work. What made you want to get into that?
Well, I had a family member who had mental health issues who got involved in the criminal justice system.
Okay.
And I got up close and personal with something I knew nothing about and saw how dysfunctional it was. And not only did I think it was dysfunctional, but when I started to talk to all the people running the system, who normally, bureaucrats protect their own, but they all agreed. They said this system is broken. Mm. And, it's a complicated political thing because for a long time, anytime somebody mentioned any kind of prison reform, their poll numbers would drop. If you were tough on crime, then your numbers went up. Mm. So politicians kept voting for jails over treatment facilities. About 5 years after we started, the tide turned. 5 years ago, if you were running for elected office and you didn't have some sort of prison reform, de-mass incarceration program as part of your agenda, nobody would listen to you, and your numbers would go down. So it was just a tidal shift where people started realizing that our prison system is broken. I don't know where we are today, but so we came in with this new idea and took 10 years to convince state officials, the Office of Mental Health, but with the support of the governor, we finally got it done.
Wow, thank you for sharing that. That's very meaningful. I have personal experience with family members with mental health issues as well, so that's very meaningful work and something you should be very proud of.
Thank you.
So wrapping up a few more questions, if you don't mind. So you have so many things going in your life, as I said, as we discussed a lot today.
I'm a busy boy.
But there's only so much you can do as one person, right? So you have to build teams.
Correct.
So how what have you learned about team building and?
Well, I feel myself very lucky because I have surrounded myself with very talented, very capable people, and my philosophy, I try to create long-term relationships, and I think part of the reason that I've been very successful with my senior management, both younger and older. Senior managers, I just had one guy retired, been there 38 years. I have people who are still there who've been with me for 40 years. And I have a whole group who've been there maybe 20 years, are many of the leaders in our company. But they started when, they're 40 now. They started when they were 20 as interns. Oh. And they're leaders in their different sectors. So, I don't know. I just try to empower people that I think have great capability and talent and bring out the best in them and be supportive and try not to tell people. I give people a goal, but I don't tell them, when to get up and when to go to bed at night. Mm. I leave it to them to achieve their personal best. Mm. And if we have people that are on a lower level, again, we want them to achieve their personal best, whatever it is, and bring that out. That's how I work, and it seems to resonate with people.
Sounds like longevity and loyalty on your behalf has helped people. When we had, as I mentioned before the show, we had Michael Rudder on last week, and he used to work for you, and he was talking such great things about you. And when he was going out on his own, he mentioned how you supported him in that. So you're definitely a leader, and you've demonstrated that by so many people that work for such a long period of time. So you're a lifelong entrepreneur. What have you learned about entrepreneurship since your age of 14, 15? You've been doing this a long time, this entrepreneurialism.
Well, I think one of the things about being an entrepreneur is you have to tolerate risk. And sometimes I give lectures to real estate students and things like that. And I always say, look, if risk makes you uncomfortable, don't become an entrepreneur. They're great jobs.
Yeah.
Work for somebody, work for an excellent company, but let the company take on the risk. Don't take it up close and personal.
Have you always been comfortable taking risk?
For some reason, I have. Yeah. I take what I call intelligent risk. Somebody maybe think it's stupid risk. So I don't just do things and hope for the best. I have a plan. I convince myself. I study it. I try to understand it, and I make sure that I can tolerate its lack of success. Because being an entrepreneur, taking risk means that you're not only taking risks to win, you have to be prepared to lose. It's not your objective, but it's going to happen. So if you can't lose gracefully, or you can't afford the risk that you're taking, then don't take it. Don't lose sleep. I sleep fine. People sometimes think, oh, how does he do it? I do it because I put my best in. I think about things, and then when I go forward, I know I'm not guaranteed a result, but usually it works out more often than it doesn't. And that's what I have confidence in, that I and my team have done the very best that we can. And
that's a great mentality to have. What do you think about yourself in the future for yourself and for Time Equities? What legacy do you hope to leave?
Well, the legacy that I leave is really the company that I've built and my colleagues. I have some phenomenal colleagues that I work with, the very people that I was telling you about. And, Michael Rudder's an example of somebody who's left, but was a leader in his field. He learned it at Time Equities, but that's fine. For him, it was the right step for him to go out and do his own thing. But we have people that are at least as talented, or dare I say, even have different talents than Michael, and they're making their careers there. And that's my legacy. And those are the people that I'm leaving in charge of when I can no longer be around. But
you have no sign of slowing down. You've got more projects going on in Palm Beach. And
one of my mentors, I guess he died when he was 93. And he always tells this funny story. He used to be partners with Larry Tisch, a man named Charlie Benenson. And Charlie told me that, 30, 40 years ago, Larry said, we need a site for a new hotel. New York needs a convention hotel. Charlie put together the land for what is now the Sheraton. It was a half a square block, and when it was all done, he said to Larry, I think I did a good job for you. I deserve a bonus. And Larry said, you're right, you did a good job. It's great land. And he said, I'll tell you what, there's a block of a Lowe's stock around, and you can get that, and it's $200,000, but I'll lend you the money to buy it, and I think it'll do well in the future. And Charlie went home and thought about it, and Monday he came back and said, you know what, Larry, I don't like owing you money. Just give me a $10,000 paid-up life insurance policy for my wife, and that'll be fine. Larry owned an insurance company.
Okay.
So Larry said, well, if that's what you want, I think you'd be better with the stock. But Charlie said, no, just give me the insurance. Well, of course, Charlie then lived to be 93, so the insurance became meaningless. The stock, he told me shortly before he died that he had somebody calculate it, what it would be worth. And he said it calculated it would be worth $500 million at the time when he was 92. And he said, well, what would I do with another $500 million? So I'm not planning to go anywhere for a long time.
Good,
and
great
Charlie shouldn't have had a short-term point of view, I'll be here as long as I can.
Francis Greenburger, it's been an absolute pleasure. Thank you for taking the time.
Thank you.